Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial news so you do not have to. And today we are looking at ACCURAY Incorporated, a company that builds sophisticated machines for cancer treatment. Specifically, we have their amended annual report on Form 10. CACR for the year ended the 30th of June 2025, which means we get to see a company grappling with some accounting errors as well, a chance to see what is really going on under the hood. So ACCURAY originally filed this report back in August of last year, but they have had to restate some of their financial statements for the fiscal year ending the 30th of June 2025, and also include some restated quarterly information. Now, the big reason for this restatement is errors they found related to something called remaining performance obligations, or RPO, which is basically the way they expect to get from contracts that are not yet fulfilled. It seems they incorrectly included certain open system orders, upgrade sales orders, and customer credits in these RPO balances, because the customer deposits for these did not have substantial penalties for cancellation, so those specific items should not have been counted as guaranteed future revenue. This is a pretty significant correction, dropping their reported RPO from over $800 million down to around $60 million for the 30th of June 2025. That is a massive adjustment, and it points to some pretty big issues in how they were tracking their future revenue. The fallout from these accounting errors also means they had to evaluate their internal controls and procedures, and surprise, surprise, they found material weaknesses in how they review footnote schedules for financial statements, and also inadequate controls for analyzing information needed for accurate financial reporting under generally accepted accounting principles, or GAAP. This all stemmed from an incorrect assessment when they first adopted a new accounting standard called ASC 606, which deals with revenue recognition. The company acknowledges that these control issues means their disclosure controls and procedures were not effective as of the 30th of June 2025. This is serious stuff for investors, as it shakes confidence in their financial reporting and could lead to more problems down the line. Now let's dive into the heart of the matter. The risk factors ACCURAY lays out a whole lot of potential problems they face, and honestly some of these are quite concerning. They are heavily exposed to global economic instability, including inflation tariffs and potential recessions, which could slow down customer purchases because hospitals might not be able to get financing for their expensive machines. They also mentioned that rising material and logistics costs due to inflation and supply chain issues have already hurt their gross margins, and they expect this to continue through at least 2025. Looking at their financials for the year ended June 2025, ACCURAY reported total net revenue of $458.5 million. That's up from $446.5 million in 2024. However, the cost of revenue also increased to $311.5 million from $303.6 million in the prior year, which squeezed their gross profit to $146.9 million. That is up from $142.9 million, but not by much given the revenue increase. Operating expenses were also high at $139.1 million, leading to an income from operations of only $7.8 million. This is a huge improvement from the prior year's operating income of just $504, but it is still a very thin margin, especially after accounting for interest expenses and other costs. The company also has a substantial accumulated deficit, meaning they have lost money overall throughout their history. Debt is another big concern for ACCURAY. As of the 30th of June 2025, they had about $136.5 million in net debt. This includes new financing arrangements for $150 million in term loans. Plus, there is still $18 million of convertible debt outstanding that is due in 2026. The company has had past issues with financial covenants on their debt and had to get waivers to avoid defaulting. This really highlights how much they rely on borrowing money and the risks associated with that, especially if their business performance falters. On a more operational note, the company is very dependent on single source suppliers for key parts of their CyberKnife and tomotherapy systems, like robots and magnetrons. If these suppliers have problems or cannot deliver on time, or if their costs go up, it directly impacts ACCURAY's ability to produce and deliver their products, and that can really hurt their financial results. Now, for the stock performance, ACCURAY's stock price has been quite a roller coaster. They mentioned the volatility and the fact that their stock price could drop significantly if they do not meet expectations. This is underscored by the fact that they have warrants outstanding that could dilute existing shareholders. If exercised, the stock price has been particularly sensitive to market conditions and company performance, which is typical for smaller growth companies, but still a risk for investors. Revisiting the internal control issues, ACCURAY states that their disclosure controls and procedures were not effective by the 30th of June 2025. This is directly linked to the RPO errors. They are implementing new controls to improve reviews of financial statement footnotes and the analysis of information for GAAP compliance. They hope to fix these. material weaknesses, but it is a process that takes time and management is actively working on it. Their independent auditor Grant Thornton LLP has given them a qualified opinion on their internal controls for the 30th of June 2025, stating that the company had not maintained effective internal control over financial reporting. This is due to those material weaknesses we just discussed. The auditor reassures that these issues were considered during the audit of the financial statements for 2025, but the fact remains that these are significant control deficiencies. In Note 2 on revenue, we see a breakdown of how they make money. Product revenue was $237.5 million in 2025, and service revenue was $220.9 million. They also recorded $62.4 million of revenue from sales to their joint venture. This JV is in China, and it is a significant part of their strategy, especially for entering the Chinese market, but it also comes with its own set of risks and complexities as mentioned in the report. The overwhelming theme in this report is ACCURAY is facing significant headwinds from the global economy, geopolitical instability, and their own internal control issues. While they did show revenue growth year over year, they are still struggling with profitability. And debt, they are heavily reliant on key suppliers. Their international operations are complex and regular. ACCURAY compliance is a constant challenge. The restatement, due to RPO errors and the identified material weaknesses in internal controls, are major red flags for investors signaling potential for further financial reporting missteps. It is clear that ACCURAY is navigating a very challenging and uncertain business environment. The company's strategy to expand internationally, particularly in China through its joint venture, is a potential growth driver, but it also adds layers of complexity and risk given the geopolitical climate and the JV partners' connections. Overall, ACCURAY looks like a company in a tough spot. They are in a growing market, cancer treatment technology, but they are struggling with execution and financial controls. The numbers show improvements in some areas, but the underlying operational and financial reporting issues are significant. The significant reduction in reported remaining performance obligations is a major correction that hints at past overstatements of future revenue. The company's heavy reliance on debt and single-source suppliers also presents considerable risks. Coupled with the material weaknesses in their financial reporting, I would say any looking at ACCURAY needs to be very cautious and understand the high degree of risk involved. So what is my take on ACCURAY's latest filing? Well, it is a mixed bag to say the least. Revenue is growing and operating income has improved significantly. However, the major restatement for remaining performance obligations and the identified material weaknesses in internal controls are serious concerns that cannot be ignored for investors. This suggests a lack of robust financial oversight and a potential for future accounting issues. The company's heavy debt load also adds to the risk profile. While their international expansion and joint venture are strategic moves for future growth, these also introduce new complexities and dependencies on third parties. The current economic climate with inflation and supply chain disruptions further exacerbates these challenges. ACCURAY is in a competitive market, and while their technology is advanced, they need to fix their internal processes and prove consistent profitability to really build investor confidence. The risk factors section alone is quite extensive. If detailing everything from competition and regulatory hurdles to supply chain issues and financial market volatility, it is a lot to juggle. What is your take on these numbers and what they signal for the company's future? Your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord server linked in the description below to join our community of financial enthusiasts. Thanks for watching. See you next time.